Prairie Operating, PROP, is currently a financial paradox. A company with an $88 million market cap sitting on $1.22 billion in PV10 value, the present value of estimated future oil and gas revenues, net of direct expenses. The fundamental disconnect reserve scale. Proved reserves sit at approximately 121.1 million barrels of oil equivalent. Asset quality. Roughly 71%, approximately $860 million, is classified as proved developed, PD, meaning these assets are already online and generating immediate cash flow, supported by a production capacity of 28,000 barrels per day. Cash flow. 2025 net operating cash flow, OCF, was approximately $153 million, nearly double the company's total market capitalization. When a company's PV10 is 10 times its market cap, it usually signals that the market does not believe those assets will ever reach the shareholders' pockets. 3 crucial lessons in capital operations. White knights are often vultures. Institutions providing capital during crises, like Series F holders, aren't looking for long-term dividends. They use complex derivatives to lock in risk-free arbitrage. They strip the assets, leaving common shareholders with the scraps. Crashes are often structural, not operational. Prop's oil production is rising and profits are turning positive, yet the stock is cratering due to the 34 million share overhang. The capital structure is destroying the market cap. Fundamentals are currently irrelevant. The leverage of the week. How did Prop negotiate a 56% reduction in dilution? High oil prices. The $1.2 billion PV10 is the final line of defense. Without those assets, the lenders would have liquidated the company rather than negotiating. Looking ahead, July 8, 2026. For shareholders, this date is more critical than any earnings report. The bull case. If oil prices stay high and PROP can secure a low-cost RBL, reserve-based lending facility, to buy out the remaining Series F interests before July, the dilution stops. The value gap between the $100 million cap and $1.2 billion assets would finally close. The bear case. Negotiations collapse, and 34 million, or potentially more, warrants flood the market in July. The total share count will easily surpass 100 million, causing a massive dilution of earnings per share, EPS, regardless of how profitable the company becomes. Alternatively, the $1.2 billion in oil assets could face liquidation. Legally, creditors and preferred shareholders sit much higher in the capital stack, liquidation preference, than common shareholders. If the core $1.2 billion in assets are stripped away, all that remains of PROP might be bad debt and abandoned wells. Your shares would still be trading, but with their underlying value gutted, they would become zombie shares, mere shells with no real asset backing. Risk warning. The author holds a small position in this stock with an option trading mindset. Investors should be prepared for the possibility of the stock price going to zero.